I was wrong to say sell, Michael Burry tweeted to his 1.4 million followers Thursday. The famed investor, who made his name by predicting and then benefiting financially from the housing collapse that caused the 2008 economic crisis, admits he was wrong in the short run to have become bearish in the current stock market climate. Most likely, Burry is only admitting to being wrong in the short run, while still believing in his previous bearish longer-term outlook for the stock market. A couple of weeks ago, Burry changed his opinion on the collapse of Silicon Valley Bank. Burry says the current crisis is not a real danger and can be resolved very quickly. This crisis could resolve very quickly, the famous investor posted on Twitter on March 13. I am not seeing true danger here. But the previous week he compared Silicon Valley Bank to disgraced energy broker Enron, and then predicted that another big bank was bound to fail, so becomes known for changing his opinions sometimes. Today we will discuss Michael Burry's warnings about the economic situation in 2023 and look into what we as investors can learn from his predictions instead of cursing and criticizing him, because his warnings have so far helped a lot of people, and that is why his enigmatic style of predicting the future got so many followers. So we will adopt a positive approach. Burry recently went on to share charts to show that investors today are behaving differently than what has been common going back to the 1920s. Going back to the 1920s, there has been no BTFT. Buy the F-King dip, generation like you. Congratulations, Burry tweeted. Burry frequently deletes his previous tweets, so it can be tough to pin down exactly what he is talking about. Thankfully, screenshots exist. He recently tweeted, 2000, 2008, 2023. It's always the same. People are full of hubris and greed, take stupid risks and fail. Experts say that Burry thinks that the banking crisis will resolve quickly, but we need to prepare for another crisis bigger than the banking crisis of 2023. Michael Burry has compared the current financial turmoil, following the collapse of multiple banks, to the panic of 1907. He recently tweeted that, in October of 1907, the Knickerbocker Trust failed due to risky bets, sparking a panic, and two others soon failed, and it spread. When a run began on a healthy trust, JP Morgan made a stand 3 weeks later. The panic resolved at market's bottom. A stand was made this past weekend. This crisis could resolve very quickly. I'm not seeing true danger here. So Burry believes their bigger investment bubble crisis still remains to be seen. In 2019, Michael Burry expressed his concern that the growing popularity of index funds are leading to overvalued stocks in the larger indexes. He called this the passive investment bubble, since fund managers are required to invest in all the companies in the index, even if some of them look very unattractive from a valuation point of view. This creates a buying frenzy, which might already have distorted the true value of these stocks significantly. Michael Burry became famous for his successful bet against the mid-2000s. The housing bubble, which was made into a book and movie called The Big Short. He has also made investments in GameStop and shorts against Tesla, and against Cathie Wood's ARK fund in 2021. Despite his SEC filing showing he's not opposed to owning individual stocks with a unique opportunity, he is still warning investors about a potential stock market investment bubble. In late 2022, Burry tweeted, "The difference between now and 2000 is the passive investing bubble that inflated steadily over the last decade. All theaters are overcrowded, and the only way anyone can get out is by trampling each other, and still the door is only so big." Burry thinks the current market collapse could be even worse than the dot-com crash of 2000 to 2001 due to the huge amounts of money parked in index funds. Bubbles exist, and they can be caused by things like passive investing. Passive investing means investing in a group of companies instead of just one. This is supposed to be safer because it spreads the risk across many companies. The biggest group of companies that people invest in is called the S&P 500. This group includes 500 of the largest companies in America. Investing in the S&P 500 people's money is connected to the performance of many companies. The main idea of passive investing in 2022 is to invest in a low-cost S&P 500 index mutual fund, like the SPY ETF. The S&P 500 has had many downturns, but it has still on average delivered a 12% yearly return on investment. But when too many investors buy and hold stocks for a long time, it can become a problem. Michael Burry believes that passive investing has contributed to a stock market bubble. In 2022, around 20% of the S S&P 500 shares were held in passive funds compared to only 3.3% in 2003. In February of 2023, Michael Burry tweeted a chart showing how the S&P 500 fell around 40% between February 2001 and October 2002. The chart also showed that the Federal Reserve's benchmark interest rate dropped from 6% to below 2% during that time. Burry wrote the quote, "This time is different," probably making fun of those who think the current market will continue to rally. Burry also tweeted a word of advice to investors: sell. To fight inflation, the Fed has raised its target interest rate from near zero as late as March 2022 to nearly 5% currently, with plans for further increases. Higher rates encourage people to save instead of spending and investing, and also makes borrowing more expensive. Michael Burry has predicted that the U.S. economy will go into a recession and face a new round of inflation in 2023. He shared this prediction in a tweet on January 2, 2023, where he is warning that the inflation rate has already reached its highest point, but there may be another peak in the future. He believes that the Consumer Price Index, or CPI, will drop significantly in the new year, and it may even become negative in the second half of 2023. This decrease in CPI could cause the recession that many people were expecting to happen a year ago. Burry tweeted, "Inflation peak, but it's not the last peak of this cycle. We are likely to see CPI lower, possibly negative in the second half of 2023, and the U.S. in recession by any definition. Fed will cut and the government will stimulate. We will have another inflation spike. It's not hard." Burry believes that passive and blind investing in index funds is destroying. True value is no longer priced based on fundamentals and therefore represents another signal of a bubble. Passive investing has removed price discovery from the equity markets with simple fees and models that get people into sectors, indexes or ETFs and mutual funds, and those strategies do not require the security level analysis that's required for true price discovery. In a November 2019's interview with Bloomberg, Michael Burry first referred to the trend as a bubble, arguing that the passive strategy was causing investors to miss opportunities to do their own research and capitalize on overlooked stocks. According to Burry, in the short-term, stocks go up and down because of supply and demand, and billions of shares of stock are bought and sold every day. It's this buying and selling that sets stock prices, and understanding supply and demand is easy. However, what's difficult to comprehend is what makes people like a particular. Whoever is willing to accept the lowest bid will set the price, resulting in a race to the bottom. Confidence in the stock market can also increase demand and prices for individual stocks. Stock valuations may be attracted to investors, or the stock market may be trending upward, leading them to think that stocks are a great investment. An increase in demand for stocks can push prices up across the board. Investors have been shifting away from properly managed investment funds and towards passive funds that just track the market over the past 20 years. Michael Burry thinks that also value investors who like to invest in good companies at a reasonable price will be affected if there's a real problem with the availability of liquidity. In such a situation, investors would sell both good and bad stocks in a particular category, and the prices of those stocks would become disconnected from their real value or risk. Burry believes that investors will begin selling all stocks in the index when things go bad. They'll have to be sold quickly and without any consideration for whether there are a sufficient number of buyers or not. During bad times, the price-to-earnings ratio may seem lower, but it reflects the expectations of lower earnings in the future. It would be relatively easy for the index to drop further as the sales pressure increases. Michael Burry's warning about the passive investing bubble has generated a lot of attention and debate among investors. While this prediction may be alarming, it's important to remember that the market is complex and unpredictable. There are many factors that influence market performance, and it's impossible to predict the future with any certainty. However, by taking steps to diversify their portfolio and stay informed about market trends, investors can minimize the risk and protect against sudden shifts in investor sentiment. So, that's all for today's video. If you have found it helpful, please give it a like, subscribe, and drop a comment below to let us know your thoughts. We will be back to you soon with another video.